2025 is almost over, and this is an amazing time for me to be sharing my investment strategy with you guys on YouTube and let you know some tricks and other things of how I find growth stocks, how I find value stocks, and what I look for in my investment philosophy and my strategy in general. And this strategy has allowed me to generate an average annual return of 32% since 2022 when I started recording everything. In 2022, I did 27%. In 2028, I did 28%. Last year was an amazing year for me. I did 54%. And this year, I was up 31% at one point, and I made some mistakes and some unexpected things happened. And those things happen from time to time, and I'm no longer up 31%. I'm slightly beating the S&P 500, and I would call it a bad year for me, as my target is 20 to 25%, and now I'm a little bit below that. But I don't let those things affect me. I have a lot of confidence in myself. I know 2026 and beyond are going to be amazing years for me, and I always learn new lessons, and I try to share my lessons and everything I learned with you guys on YouTube. But before I get into the specifics of my strategy, I want to highlight some of the principles that I believe in allow me to implement the strategy in the beginning. And if you do enjoy them, again, they don't get a lot of views. So all I'm asking is please press the like button and let me know if you enjoy it or if you don't enjoy it down in the comments. The first one, and this is the biggest one for me, it's a non-negotiable, and I think some beginner retail investors, they make this mistake. And this is that I don't marry my stocks. Warren Buffett says you might have all kind of feelings about a stock, but the stock doesn't have any feelings about you. The stock is too dumb to know you even exist. So the problem is some investors, they start listening to the CEO, they read about the company, maybe they use the products. You have a Tesla, you fall in love with Tesla, you fall in love with the CEO, you fall in love with a certain product or whatever, and then you invest in the company. Now, the only problem is you're going to be blinded from any potential red flags that are telling you this is the time to sell, this is the time to get out before the stock goes much, much lower. And there are certain things that are clearly deteriorating, but you're not going to be able to see them because you married the stock. You're so in love and emotionally attached to the company that you can't see those red flags. And a popular one was Tattooed Chef back in 2021, 2022. And people married the stock, I mean, I think it went to zero. But I had my fair share of those stocks that I exited, and people believe I have like perfect timing or whatever, and I really don't. But I'm just open-minded and I look for the red flags. One of them was Computer Modeling Group, where if I held the stock, I'd be down 51% this year. Lakeland is another one. I would be down 69% this year. And another stock I talked about back in 2021 was Else Nutrition, which they make plant-based milk for toddlers. They were the first ones to make it, and they put it in the United States. And the stock is down 97% since 2021, and I sold it in late 2021. And I was seeing clear red flags and the fundamentals deteriorating. And sometimes I did sell stocks and the stocks went up. So the moral of the story is don't marry your stock so much that you're blinded to any risks related to the business model or related to the valuation where the stock is just so expensive you can't justify it. And maybe it's time to take some profits. There's some stocks, they remain flat for 10, 15, 20 years. Microsoft was flat for 16 years from the 2000. And you would have been dumb not to sell Microsoft at 100 or 120 times sales, I think it was. And it was clear. But if you was emotionally attached to Microsoft and you love the Microsoft product, you would not have sold Microsoft. So this is a big one for me. The second one is I focus on generating returns. So I don't really care too much about narratives, about doing something that makes me feel a certain way or something that makes me excited in a certain way. I don't really bother with such discussions in general, political discussions or any kind of discussions. And my main goal in the market is to generate returns. That's why I'm investing. That's my goal, and that's what I focus on. The third one, which I didn't really want to share it, but I thought I would talk about it a little bit, and this is that I try to follow the trend. So a lot of investors, especially value-related investors like I was initially, they love being contrarians. They love betting against the crowd. So if everyone's talking about AI, they want to be contrarians. They want to short NVIDIA 3 years ago. They want to do all these kind of things. But the truth is, most of the time, it's good to be with the trend because the kind of crowd is mostly right. They're not always right, but they're mostly right. And sometimes they're early, and that sentiment could feed on itself. So I try to follow the trend in a certain way where, for example, I believed NVIDIA was overvalued. I bought Constellation Energy, which is a utility company that powers the data center. So I was kind of following the trend, but I'm always mindful of inflection points when I believe, something is deteriorating or something is changing in general. Now, in terms of my strategy, I try to put in 60% of my portfolio in what I would call the quality stocks. Those are wide mode businesses, long-term compounders, and they should deliver at least a 20% annual return. One of them could be Amazon as an example, where Amazon is trading at 16 times operating cash flow, and it's expected to grow operating cash flow 20% for the next 3 years. So I believe Amazon has a decent chance of potentially delivering a 20% annual return. Another stock that I shared was Brookfield Asset Management, where the company's management team have a very good track record of under-promising and over-delivering, and they are guiding up to 20% earnings per share growth for the next 5 years, and you're also getting about a 3.7% dividend. So I'm not seeing how I'm not going to get at least a 20% annual return from Brookfield Asset Management or Amazon or these kind of stocks over the next 3 to 5 years. So that's what I look for. I want a quality company with a moat competitive advantage, and I need to see at least 20% annual return, which is not life-changing gains, but that's like the minimum I look for. Then I put in 20% of my portfolio in the growth stocks. Now, the growth stocks are what has allowed me to get those magnificent returns. Like Robinhood this year was up, 300%. Mama over the last 2 years was up 750%. Sometimes you get those runs. But with the growth stocks, I'm focused on 25% plus annual return. And I try to do that by trying to pay a fair price to sales multiple. And there's a few things that I look for, and I'm going to give you the list over here. Now, one of them is I want to pay 3 to 5 times sales is a sweet spot. So this is like the sweet spot when I'm buying a growth stock. Not more than 10 times. 10 times is the ceiling. I can never pay more than 10 times sales for a growth company. The reason why we're using sales is because the company it's an early stage of the business cycle. So they're not too focused on being profitable. They're intentionally focused on growing, which is why I use a sales multiple. So 3 to 5 times sales, at least 20% revenue growth. We want a clean balance sheet because we don't want the company to be diluting us to the stratosphere. We want high gross margins, which would show us that the company has some kind of a competitive advantage. There's not a lot of competitors that are squeezing their margins. So we want high gross margins, and we want the company to be within 1 year of profitability. We don't want to bet on Virgin Galactic going to the moon or wherever they want to go 50 years from now and diluting us to the stratosphere. We don't want to invest in stories. We want to invest in solid companies. 3 to 5 times sales is, the ballpark. 20% revenue growth, clean balance sheet. But the important part about them is they have to be in a industry that's being disrupted that has a large TAM. For example, SoFi is a good one because they're growing earnings per share more than 25% annually, and they're disrupting the fintech-related space. They're taking market share from Bank of America, JP Morgan, and Wells Fargo. That's huge, guys. The TAM there is huge, and I love it very much. Same thing you could say with HIMS, was in telehealth, or even Robinhood was in the brokers, active brokers and Fidelity, and they're taking market share from them, which is really amazing. And a recent idea I talked about is the silicon-based batteries, where you have a lot of those flying taxis coming up, a lot of drones, delivery drones, robotics, all those kind of robotics, they require batteries. And the silicon-based batteries have something a little bit special. And I wrote about this in my Patreon, which you could join for free and read the article if you're interested. But I look for a large TAM, 3 to 5 times sales, 20% revenue growth. And I try to put in about 20% of my portfolio in those kind of stocks. I don't do it all at once. I don't put 20% in one stock alone. I kind of put in 3 to 5% position in each one, and then they grow over time. So around 20% of the portfolio is in the growth names in general. Now, 15% of the portfolio, I put it in something called the defensives. So defensives are stocks that are not going to give you life-changing returns, maybe 12% a year, 13% a year, but maybe even up to 15% a year. Those defensive kind of stocks, they stabilize the portfolio a little bit. Because if the market is going up, the quality stocks will be going up and the growth stocks will be going up. If the market's going down, the quality and growth stocks will get destroyed more than the market. So you want something that's not too correlated to most of the market, that could potentially hold up or even go up whenever the stock market is going down, and it just stabilizes the portfolio in general. Now, one of those stocks you could say, or a list of them, is you could look at the stocks that did well back in 2007, 2009, and you could notice a pattern. One of them was AutoZone, which went up 22%. Walmart went up like 10%. McDonald's was barely down 2.9%. Dollar Tree did well. O'Reilly Auto Parts did well. And a lot of those auto parts stores and utility companies, necessity, recession-proof stocks, those kind of stocks will do really, really well. Now, the trick about those recession-resistant stocks is I try to use them as a potential cash position. So let's say, for example, back in 2023, I had a position in McDonald's stock. McDonald's stock went up 15% whenever we had the Silicon Valley Bank kind of mania. And then I sold the stock for 15% gain. I took the gains and I bought the growth stocks when the growth stocks were going down. Then when the growth stocks recover and they get overvalued, I eventually want to trim those growth stocks and start buying into some defensive stocks, let's say waste management, or maybe back British American Tobacco, or those kind of stocks that are hated because they normally go down when the market's going up. And when the market is going down, those boring stocks will be going up. And I try to do the opposite, where I buy what people hate and sell them when they love them. And I do it with about 15% of the portfolio in defensive related stocks. And then around 3% of the portfolio, I put it in a speculative stock. I always keep one speculative stock. For now, it's Ouster. There's going to be a second one, which is a battery related stock. I'm still waiting for my price target. But Ouster, as an example, I told you guys the stock could up to 20x over the next 10 years. But this is something that is unprofitable, really. It could be profitable in a year or 2 years. And it's just a wild bet in general, where if it does work out, you could make a lot of money. If it doesn't, then you don't lose too much. And I normally don't do that. I never did that before. But then if you notice the pattern with a lot of those stocks, like Oklo is going up thousands of percent before they even hit profitability or they even hit revenues. Rocket Lab was going up hundreds of percent from $4 per share before they were even close to being profitable. So with the growth stocks, I focus within 1 year of profitability, but 2 to 3% I put it in a speculative investment where it's just really speculative. But if it does work out, then I hit it out of the park. But if it doesn't work out, then I lose a small percentage, let's say, 1% of my portfolio, 0.5%, and I just move on to another one. Now, the last percentage of my portfolio is in options, and options not really 2%. Sometimes it's a little bit more, sometimes it's a little bit less, sometimes it's really nothing. But sometimes I like to sell options. One of the recent ones I sold, as an example, was SoFi. So SoFi was going down a lot on pretty much 2 weeks ago, and I noticed that there was this January 2026 option, which was next month, it's a month from now. It was yielding a 2% return. So if I have the obligation to buy SoFi at $22, I'm gonna get paid 2% per month for me to buy SoFi at $22. Now, maybe I never get assigned, or even if I get assigned, I don't mind. But this is a crazy return, and it was an inefficiency in the market, which happens during volatile times. And you're getting 2% a month. On an annualized basis, this is 24% annual return alone from selling puts on SoFi. And this put is already up 56%, so you can't really replicate the trade anymore. But sometimes you find those opportunities where you could generate 1 to 2% per month by selling options on stocks that you don't mind owning if you get assigned, and you could hold them for the long term, or even sell covered calls on certain stocks and collect extra returns. So sometimes I do options to also hedge my portfolio if I believe the market could potentially go down. But this is what I mainly do. It's a little bit of a complicated strategy, but I do a little bit of everything: the quality stocks, growth stocks, a little bit more in defensives, so value investing, you could say, more in the speculative stocks, and also within options, as my goal is to generate returns and not to follow narratives. And if you believe you have the same mindset as me and you want to learn a little bit more options, or you want to learn a little bit more about picking certain stocks and follow everything I do, I share everything in my own group, and this is the link if you're interested. But thank you very much for watching, guys. It was not financial advice, so I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.